Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review before I go to sleep today and just want to crank out another video. Now, every time I make a video about the first lien HELOC, instead of people refuting my math, what they do is just talk about how you're wrong because the amortized loan is an amortized interest and the HELOC is a simple interest. Now, this person wrote this question. It's not saying I'm wrong, but basically it wants to know, and I've addressed this in other videos, but I don't mind addressing it again. Isn't there a difference between the amortized interest of the mortgage, although lower, and the simple interest of the HELOC? And let me actually have the AI voice read it out loud for you just to kind of re-emphasize the question. I don't know if that's actually how you grammatically say it, but it's okay. Let me go ahead and reread it.
Isn't there a difference between the amortized interest of the mortgage, although lower, and the simple interest of the HELOC?
The answer is pretty much no difference, okay? And I'm gonna go ahead and explain it to you. So, there's this thing when it comes to velocity banking that I see online where it's like amortized loan bad, line of credit good, and that's actually not always 100% true, and you can't make blanket statements like that. And what happens is when you make blanket statements like that, people will do things like get first lien HELOCs even though they probably should not. In fact, you want to know what a good starting point is? If some you hear something on the internet and you don't know if it's a good idea or not, just ask the AI, ask ChatGPT. In fact, let me pull up a query that I made to ChatGPT just a few minutes ago. Give me one moment. Yeah, here we go. That's an old one that question that I asked ChatGPT. I heard on a YouTube velocity banking videos that amortized loans are different from lines of credit when calculating interest. Does that mean it's a good idea to replace my 2.5% mortgage with a 10% HELOC? And look at the first word. No. So again, here's the thing. Here's how here's almost a 99.9999% surefire way. I'm not saying 100%. It's kind of like those germ commercials where they say like, "Oh, this can get rid of 99.999% of bad germs," right? Well, this is like a 99.99999% way of making sure that you don't, something bad doesn't happen to you. Do the math yourself. Real estate investing is just math disguised with houses, right? Same thing with like any type of financing. Like a car literally is an excuse to sell a car loan, right? So same thing with real estate investing. We got to do the math, okay? So let's go ahead and read the answer.
No, it's not generally a good idea to replace a 2.5% mortgage with a 10% HELOC, despite the differences in how interest is calculated. Here's why. Differences in interest calculation. 1. Amortized loans, like your mortgage. Interest is calculated on the full principal balance up front and is spread over the life of the loan. Most of your payments at the beginning go toward interest, with more going to the principal later on. 2. Lines of credit, like a HELOC. Interest is calculated based on the average daily balance, so it can be lower if you pay down the balance quickly. Why replacing a low-interest mortgage is risky? Interest rate difference. A 2.5% fixed-rate mortgage is far cheaper than a 10% HELOC, even with faster principal repayment strategies. Variable rates. HELOCs often have variable rates, meaning they could go even higher, increasing your costs. Long-term costs. While velocity banking can save interest over time by leveraging cash flow to reduce the average daily balance, the higher interest rate on the HELOC will likely outweigh the benefits of faster repayment. Tax implications. Mortgage interest might be tax deductible, but HELOC interest is only deductible in limited cases, e.g. if used for home improvements. When it might make sense. Replacing a mortgage with a HELOC might make sense if 1. You have a regular or variable income and need flexibility. 2. The HELOC rate is lower than your mortgage rate, not your case. 3. You have a strong plan to pay off the HELOC balance aggressively within a short time frame, minimizing interest charges. Said recommended strategy. Instead of replacing your mortgage, consider using the HELOC as a tool to pay off the mortgage faster. 1. Use velocity banking principles by leveraging the HELOC for large, targeted payments toward your mortgage principal. Number 2. Pay down the HELOC balance quickly using your income, effectively cycling the debt to minimize the average daily balance. Would you like me to model a specific example of this for your case?
No thanks. I'll do it myself. But, okay, see here, using the HELOC as a tool to pay off the mortgage, not replacing your mortgage, okay? Now, if you take a look here where it talks about the amortized loan, this actually is assuming that you only make the monthly payment and no more than the monthly payment. Because if you overpay an amortized loan, the monthly payment stays the same, but the balance decreases, and it also decreases the time, right? So the interest is not all of it calculated upfront, but if you're making in 30 years, then it's predictable how much interest you pay. So hopefully that makes sense. And if it doesn't, that's okay. That's okay, because I'm just going to do the calculations here with you one more time. Okay. So let me go here and I'm going to just show you a few things. So this, unlike other people, and I'm not going to call out anybody because maybe people have done the math. I don't know. I don't watch everybody else's chance, but this is a HELOC statement. This is a mortgage statement. So I've had both, and right now, I have a 280,000 first lien HELOC, but I got it after I uh, eliminated my mortgage, right? And this is me imagining how I would be once I first got the HELOC, right? So this is me paying off my mortgage in about 3 years. Now, if you take a look at, whoa, what happened here? This is crazy. Okay, if you take a look at the HELOC statement and the mortgage statement, what is the difference? I'm going to tell you the difference. It's mostly the same. The difference between the HELOC and the mortgage is that the HELOC it calculates the interest based on what you call the average daily balance, right? And the mortgage calculates the interest on the outstanding principal balance, which is almost kind of the same as the average daily balance, right? Because when you make a payment to a mortgage and then the principal balance dies down a little bit for that entire month, because it's not going up and down like it is a HELOC, the statement balance is essentially the average daily balance. So that's why it's like, yeah, kind of, but not really. It's kind of different, but not really. And it's not, quote, amortized interest. It's just both simple interest, unless you make late payments or your payment is so low that the interest actually adds back to the principal of the loan, right? So that's why a lot of people, when they have those income-based repayment programs where the payment is so low compared to the actual loan amount, they're like, what? I thought I owed $100,000, and then like 5 years later you owe 150. Okay, if that didn't make sense, I'm just going to show you the calculations. Okay, so let me just do this here. This is the average daily balance of a line of credit. So if you want to calculate the actual interest, look at this interest rate. So it's the average daily balance. So 1467 times the interest rate, right? So times 0.10375. And then you divide by 12 to get this monthly periodic rate. Okay. And you see this right here? Let me actually zoom this 1268, right? This one's 1269. So there's a little bit of rounding math, right? Or maybe they're pulling an Office Space trick where they're rounding pennies, right? So can may make a little bit more money than they should be making. But you see where I get this? It's average daily balance times the monthly periodic rate, or the monthly periodic rate is this divided by 12. Okay. Now let's do the same thing with our mortgage. Okay. So what we do is we go here. Whoopsie. Oh, it's going crazy. Okay. We go here. We take the outstanding principal balance, right? Get the interest rate and you divide by 12. Now, the outstanding principal balance is pretty much the average daily balance. It really is, right? Like, all right, so let's go ahead and do this. So 167,656.81 times 0.0278875 and then you divide by 12. And then we take a look at that. So let me go ahead and open this up. So 401.67, $401.67. That's the interest. What? Take a look here. 401.60, and this is rounded up. 401.68, right? So that's the interest. So you notice that's pretty much the same formula. The only difference is average daily balance, and this is kind of like the semi-average daily balance because loan balances don't fluctuate like a line of credit. See how easy that was? It's not really that different, okay? And the best way to make sure that you don't get screwed is do the actual math. Remember, real estate investing is just houses disguised as mathematical formulas. Really, that's really all it is. And so I'm just going to do another demonstration for you regarding this, okay? So we're going to do a comparison of the first lien HELOC, and maybe I should put replacement, mortgage replacement, yeah, versus, and we'll just do this. Can I wrap this? How do I wrap? Let's wrap. Versus the second lien HELOC, and we're not replacing the mortgage, okay? And in fact, I don't know if you know this who Harsh Gill is. Harsh Gill, right? He's the founder or the supposed originator of all this mortgage HELOC stuff. He even says, don't do it. You're exposing your entire loan amount to the variable interest rate, and take out a smaller HELOC as a second mortgage is more recommended. See, even back in the day, they recommended it. 2003, I think. All right, so let's go ahead and do a demo. So first lien HELOC, second lien HELOC. So if we do the velocity banking side of all of this, right? Let me go ahead and copy and paste. Let's do the first lien HELOC. So if we sum up this debt, all of this, and I think I summed it up, it's $307,000 of total debt. So let's just assume that we have a $307,000 limit, full maximum capacity first lien HELOC. Now, what happens when we move all of our debt into the line of credit? Well, basically all these payments go to zero, okay? So now we have $4,000 of cash flow, but it's $4,000 before the interest costs of the line of credit. So let's go here. Let's do this. And I'm going to just do this. Okay, so this one is previous month's balance, previous month's interest minus our cash flow is our next month's balance. But oh, wait, we got to calculate the interest cost of the line of credit, which is based on the average daily balance, multiply by 0.08 and then divide by 12, right? We always want to divide by 12, and we just copy and paste. And then if we just copy and paste enough times, we can see how long it will take us to pay off that line of credit. Paycheck in, expenses out, paycheck in, expenses out. Okay, so let's go ahead and do that. And I'm going to copy and paste. And we see here, I'll just put a 0 here, that it takes us 108 months to pay it all off. So 121 grand. So let me actually just do this. 108 months, 121K of interest. We'll do it that way. We'll simplify. So let me go ahead and do this right here and copy and paste our results. Okay. And so now that's pretty much how long it'll take for a first lien HELOC to pay off everything. So let's now do it with the second lien HELOC, okay? So the calculation is relatively simple. And when we do a second lien HELOC, we pay off loans and lines of credit in a certain order, and we do it in a certain order in order to maximize payoff efficiency, okay? And here we go. So actually, let me just make sure that our loan calculator here is set up correctly. And if we take a look here, auto loan. Okay, I think it is, right? So what's the current month right now? Well, actually, this is a second lien HELOC. So let's assume with the second lien HELOC, we have maybe a $65,000 limit. And instead of putting everything into the line of credit, we just start off with a few debts at a time. We start off with the credit cards first because they have the highest interest rate and take up the most cash flow. So what we're going to do is do right here, 62000, 62,000. And then guess what happens here? Ooh, I like this cash flow. Okay, so now let me just do this. So what's our cash flow right here? It is 2362.8. And then we just gotta copy and paste. Okay, copy and paste. You see how fast I do this? Because I've done this a gajillion times. Okay, so now this one takes about 29 months. Okay, 29 months. And let me go ahead. So let me just do this and sum it up, right? So 6.1 grand at 29 months. So I'll just do this right here. CC credit card, 29 months, 6.1K of interest. Okay, that's how long it took to pay off the interest there. And then, okay, so now we tackle on the next debts. So let's do the auto loans. So I'm going to just go right here, and this is going to be okay, so 29 months, right? So 29 months, I'm just going to put in 29, 29, 29, right? So take a look here. These are the 3 loans, and I'm going to move these two, right? These 2 loans into line of credit for ultimate cash flow. Look at that cash flow index, G2 plus G3. So about 24 grand into that line of credit. So we're going to do that right here. I'm going to do that right here. Values. And then this is going to be plus 24615.18. Okay. And so now what happens to our cash flow? These both go to 0. And then now our cash flow is about $3,209. Ooh, all right. So now let's go ahead and do this. And then do this. Okay. So this is going to be 3209.76. And I'm going to do this, copy and paste. And we see that in 37 months, all paid off, right? So let's see how much interest we had to pay. So let's just make it easy right here. This will be 0. And then we'll just sum up the interest from here to here. So I'm going to, let's see, can we do this? 718. 718 at 37 months plus, okay, the interest costs here. Hold on, what did I do here? Okay, so what's the interest of these two? So that would be J2 plus J3, 4,716. So let's just copy this, paste, and then the sum of these two. So we'll say 4.9 grand. Okay. So now the auto loans is going to be 4.9K of interest. And then we're going to do this and how long, including, so we're at month 37. Okay. So 37 months. 4.9K of interest. And then what's the next thing we got to pay? The mortgage. Oh my goodness. All right. So let's go ahead and do that. Rah, 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 rah. Remember that from Tim the Toolman Taylor? Rah, 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 rah. Oh, you probably don't know who, some of you might not know who Tim the Toolman Taylor is. Okay. So now this is 37 months. And luckily, I have the velocity banking calculator up and running, and I think I have everything there, right? 37 months. I got all the deets in there. And take a look at this, 4.1 years and 10 grand of interest. So 10782.82. So let's go ahead and do this. 10782.82. And then I gotta just do copy this. So now it's 25.6 grand, right? So 25.6 grand, so say mortgage, 25.6K of interest. And how much more time? So this is going to be 4.1 years, and then all I got to do is just do 4.1 divided by 12. No, that's the wrong way to do it. What am I doing? It's 4.1 times, actually, let me see, 4.1 times 12. So we'll say 50 months, right? 50 months, okay, total to pay off everything, right? So 50 divided by 12, what is that? 50 divided by 12, yeah, we'll just say 4.2 years, okay? So what's the end result? 4.2 years to pay off everything, and the interest is 6.1 plus 4.9 plus 26.5, 37.5K of interest. And then here, I just got to copy and paste this. So what's 108 divided by 12? 9 years. Woo, 9 years. That's a no bueno. 9 years and 121K of interest. So you wasted about 9 times 4.2, 4.8 years wasted. And then here we do 121 by 37.5, 83.5K interest wasted. So as you can see, um, oh man. Again, I'm not laughing at you if you actually do this. It's just, it's kind of sad that people are blindly promoting this without doing the math. That's all I'm saying, right? And again, when it comes to real estate investing, you got to do the math. It's not about how beautiful the house is or whether it's your dream home or whether something is called amortized or not. It's about doing the math, and you need to do the math, right? Which I do pretty much every single video. Yep. So pretty much no difference between quote amortized versus not amortized based on how interest is calculated, but just the fact that people segregate their income. Also, that the amortized loan is a one-way street, almost 99% ensuring that most people will never pay more into that amortized loan. We can use the help of a line of credit to pay it off, right? Like we can do that. So, but it's not, there's no real difference about how the interest is calculated. And this is why what people get wrong, because that, velocity banking is not just a line of credit better than loans, right? It's about using a line of credit strategically to pay off all of our debts. Okay. All right. Well, I'm getting sleepy now. Tomorrow is New Year's Eve, and so let's see how many videos I crank. And I'll probably not crank out that much because I am probably a little bit lazy. All right. Well, that's it for today, folks. Have a great night, and we will speak next time. This is Korean Atlanta Mentorship.